What if Elon Musk had lost absolutely everything in 2008? It's a crazy thought, right? Because the astronomical fortune we associate with him today, it didn't always exist. In fact, it was built through a series of extremely risky, almost reckless bets that pushed him to the absolute brink. Picture this. It's 2008. Tesla is struggling to keep the lights on. SpaceX had already suffered multiple catastrophic rocket failures. And to top it all off, the global financial crisis was actively destroying businesses all around the world. Musk was rapidly running out of money, and he was staring down a brutal choice. He had to decide which of his companies was actually worth saving.
This was a massive, existential triple threat. You see, it's so easy for us to forget that before Tesla became this global titan, and way before SpaceX was casually landing rockets on drone ships, Musk was literally putting everything he had on the line. He wasn't pulling in some massive guaranteed salary. He was fighting a desperate war for survival on multiple fronts. But to really understand how he survived this impossible situation, we have to rewind a bit.
Chapter 1. The First Big Bet. Now, most people actually miss this early part of Musk's story. If we jump back to the mid-1990s, his very first major venture was a company called Zip2. It was basically a software company that helped physical newspapers build online city guides. Now, sure, it might not sound revolutionary today, but remember, the internet was basically in its infancy back then. Fast forward to 1999, Comcast acquires Zip2, and Musk walks away with millions of dollars. For almost anyone else on the planet, that kind of payout is the finish line. You buy a private island and retire. But for Musk, those millions were just starting capital. He wasn't interested in simply being wealthy. He wanted to build something much, much bigger. Chapter 2. From Zip2 to X.com. So, instead of playing it safe and protecting his new fortune, Musk took that capital and launched X.com, jumping headfirst into the incredibly tricky, unproven space of online payments. Through mergers and rebranding, that venture eventually became PayPal. And in 2002, eBay swooped in and acquired PayPal for a staggering $1.5 billion in stock. Musk's personal cut from that deal was enormous. Suddenly, he had this massive financial base. It was the crucial stepping stone. One successful, high-stress exit gave him the war chest he needed to attempt something extraordinarily ambitious.
Chapters 3 and 4, The Twin Crises.
So what would you do with that kind of money? Buy up safe commercial real estate? Invest in blue-chip stocks? Well, Musk made a decision that looked, frankly, completely reckless to outsiders. He poured enormous amounts of his own fresh capital into two startups that were nowhere near guaranteed to succeed. On one side, you had Tesla. He joined as an early investor and chairman in 2003. Back then, electric vehicles were basically a joke to legacy automakers. Battery tech was prohibitively expensive, and figuring out how to mass-produce cars from scratch is notoriously brutal. Money was just vanishing. And on the other side, SpaceX, which he founded in 2002. His goal to drastically slash the cost of spaceflight and make humanity multiplanetary sounded like pure science fiction. We're talking about massive physical engineering challenges where there is absolutely zero room for error.
And reality set in very quickly. SpaceX's first 3 Falcon 1 rockets, they failed. Think about the heavy gravity of that for a second. Every single launch represented years of intense, grueling engineering and millions upon millions of dollars. 3 explosive failures meant SpaceX wasn't looking like a success story at all. It was looking like a company rapidly approaching a cliff.
Chapter 5. 2008. The year everything almost collapsed.
And this brings us right to the emotional climax of this explainer. During this period, Musk did not look like an unstoppable genius. Quite the opposite. SpaceX was literally down to its last pennies. Tesla was on the verge of bankruptcy. And all around them, the global economy was in a total freefall. The personal financial pressure on Musk was immense. So, in September 2008, the 4th Falcon 1 rocket sits on the launch pad in the Pacific. It was a literal do-or-die moment. If it blew up, SpaceX was done. The 4th attempt had to work.
And the launch succeeds. It reaches orbit. The relief in that control room must have been absolutely monumental. But here is where the story gets really intense. There was still a massive problem. Musk was fighting a desperate war on 2 fronts, remember? Sure, the rocket worked, but SpaceX desperately needed a paying customer to survive, and Tesla was still actively bleeding cash. The companies were technically alive, but just barely breathing.
Then, at the 11th hour, came the ultimate lifeline, $1.6 billion. That was the value of a massive commercial cargo contract that SpaceX finally managed to secure from NASA. Combine that with a frantic last-minute round of financing that Tesla somehow scraped together right before Christmas, and both companies were pulled back from the brink of death. You see, Musk's empire wasn't created by just making one lucky, brilliant investment. It was forged by surviving a brutal gauntlet where those investments could have easily gone straight to zero.
Chapter 6. The Power of Ownership. So how exactly does surviving a stressful corporate crisis translate into billions and billions of dollars? Well, it all comes down to understanding net worth. And this is a crucial takeaway. A massive corporate paycheck is not what makes someone a billionaire. Net worth is a completely different beast than the cash sitting in your checking account. Musk didn't have billions of dollars just chilling in a vault somewhere. A huge portion of billionaire wealth is tied up in ownership equity. The formula is simple. Capital buys you ownership, and if that company survives and grows in value, your slice of the pie becomes exponentially more valuable.
Let's break down the math, because this is where the financial magic actually happens. Imagine you own a 20% stake in a startup valued at $10 billion. On paper, your net worth from that stake is $2 billion. Not bad, right? But what if you stubbornly hold on to that equity? In over a decade, that company explodes into a $500 billion giant. That exact same 20% ownership stake is suddenly worth $100 billion. No one handed you a $98 billion paycheck. The value of what you already own just expanded massively. That right there is the core engine behind almost all modern billionaire wealth. And that is exactly how it played out. Because Tesla survived 2008, it eventually transitioned from this risky niche car startup into a massive global technology and energy juggernaut. Wall Street stopped looking at it as just a car manufacturer and started valuing it as the literal future of energy. And because Musk held on to his ownership equity with an iron grip through all those terrifying early years, the value of his stake went completely parabolic. Those initial risky bets were finally compounding.
So looking back, we can see a relentless, repeating system. It wasn't a crystal ball or predictive magic. It was a cycle. Take capital from an early win, roll it entirely into ownership in high-risk, world-changing startups, survive the inevitable crises, and watch that ownership morph into unprecedented wealth. Then, you use that new wealth to make even bigger bets.
Now, most people simply can't, and honestly probably shouldn't, try to copy this strategy, because the exact same extreme bets that create extraordinary wealth are the same kinds of bets that completely bankrupt people every single day. But in this specific story, the brutal foundations were laid, the companies survived the gauntlet, and an empire was born. So I'll leave you with this question. If you had absolutely everything to lose, could you stomach the risk required to build the future?
How can one person's wealth rise by billions of dollars without that person receiving billions of dollars in salary? Seriously, think about that for a second. We see these wild headlines all the time. Someone's net worth jumping up by absolute fortunes in a single day. But where does the money actually come from if it's not a paycheck?
The answer is ownership. Tesla, SpaceX, Starlink, AI. These aren't just companies in Elon Musk's business empire. They are assets, and their changing valuations can dramatically change the value of his personal wealth. So how does this wealth machine actually work?
Today we are diving into Section 3, the wealth machine, Tesla, SpaceX, AI, and ownership. In this explainer, we're going to break down exactly how this machine turns business growth into extreme personal net worth.
But here's what most people misunderstand. To really get this, we have to look at the difference between income and ownership. Let's look at a simple comparison. Imagine person A. They pull in a massive $10 million annual salary. Pretty incredible income, right? Now look at person B. They don't have that crazy salary, but they own 10% of a $1 billion company. At this moment, person B's ownership stake is theoretically worth $100 million.
And this is where the numbers become interesting. What happens if that same company grows and suddenly becomes a $100 billion company? Assuming their stake hasn't changed, person B's 10% just became theoretically worth $10 billion. They didn't have to march into a boss's office and ask for a $10 billion raise. They didn't need a salary at all. The underlying asset itself just became more valuable. And this is the exact principle we saw play out as Tesla transformed from a super risky startup into a global powerhouse. The company became more valuable, so the owner's stake became more valuable.
The important part isn't the salary, it's the ownership, and specifically understanding paper wealth. You see, Tesla's massive rise on the public stock market was driven heavily by investor expectations. People were betting on the future growth, future autonomous driving. Those expectations pushed the stock price up. But this is crucial. That creates paper wealth. It's simply the estimated value of the assets owned. It does not mean the owner was just handed billions in liquid cash to deposit in a bank account.
But Tesla wasn't the only engine. Then there was SpaceX. Now, here's a question for you. How do private companies build extreme wealth when they don't even have a stock ticker changing every second on a public exchange? Well, private company valuations work differently. They're usually determined during financing rounds when private investors buy in as the technology develops.
And this creates a fascinating financial chain. Let's track it. First, SpaceX engineered a massive breakthrough, reusable rocket technology. Step 2, that breakthrough directly led to drastically lower launch costs. Cheaper launches mean you can attract way more customers, which leads to Step 3, a much larger market. And ultimately, that combination drives Step 4, a higher valuation for the company. The engineering literally turns into finance. Better technology, lower costs, higher valuation.
Now here's where the wealth machine really starts working on overdrive. SpaceX added Starlink. Compare a traditional rocket launch to Starlink. A rocket launch is a single transaction. Someone pays, the rocket goes up, boom, it's done. Starlink, on the other hand, is a recurring subscription. It's thousands of satellites providing internet to millions of people, paying every single month. By shifting the business model to highly lucrative recurring revenue, the overall company becomes infinitely more valuable.
So what we're really looking at is a stacked portfolio of massive assets: Tesla, SpaceX, Starlink, and now xAI. Each of these businesses has completely different economics. They have different customers, different growth trajectories, and different risks. This extreme wealth is actually built on this diversification. It's not about one single paycheck. It's a web of high-growth equity stakes. Which brings us to the newest frontier, artificial intelligence. xAI enters this story with a massive structural advantage because software scales entirely differently than physical factories. Think about it. If you want to double car production, you need to physically build new factories, buy more materials, hire more workers. It's heavy and it's slow. But an AI system, once it's developed, it can theoretically serve millions of users worldwide almost instantly. But building that AI is mind-bogglingly expensive. You don't just write some code on a laptop in a garage anymore. You need massive compute infrastructure. You need highly specialized, incredibly expensive chips, and you need top-tier engineering talent. So the AI race isn't just about who has the smartest algorithms, it's about who has the capital to afford the physical infrastructure. Ownership and scale are absolutely crucial to winning. But there's a catch. We've spent this whole time talking about wealth going up and up. But what happens when those valuations fall? Because remember, this market is driven by expectations, and investor expectations can shift in a heartbeat. And this is where billionaire wealth becomes very different from ordinary wealth. Ownership acts as a massive financial amplifier. It magnifies the upside, absolutely, but it equally magnifies the downside. If a new technology flops, if AI underdelivers on the massive hype, or if a private financing round suddenly values the company lower, billions of dollars in paper wealth can literally evaporate overnight. But this creates another problem, or rather a vital reality check. We have to separate liquid wealth from net worth. When you hear someone is worth $100 billion, don't picture a giant swimming pool filled with cash. Net worth is just the estimated value of a collection of assets minus liabilities. Actually converting massive private stakes or huge blocks of public stock into spendable, liquid cash is incredibly complicated. It triggers massive tax bills, alters company control, and can completely spook the market.
So how does this machine keep running despite the risks? It's essentially a repeating formula. Early startup successes generate initial capital. That capital gets poured right back into high-risk bets to secure ownership. If those bets grow, the valuation skyrockets, creating massive equity value. And that equity value grants the financial power to make even bigger bets, letting the cycle repeat all over again.
Zooming out, there's a universal lesson here that applies to all of us, even if you never plan on launching a rocket. It comes down to two fundamental ways of thinking about making money. You can sell your time. You work, you get paid. But the second you stop working, the income stops completely. Or you can own assets. You build a business, buy shares, create something. When you own assets, their value can compound and increase completely independently of the hours you physically put in.
Which leaves us with this final, powerful thought. Income can pay your bills, but ownership can build wealth. Now, obviously, survivorship bias makes us forget the thousands of businesses that fail along the way, but the biggest financial rewards always come from participating in the value a business creates rather than just working for a wage. So I'll leave you with this question to ponder. If this entire wealth machine is built on ever-expanding valuations of the future, what happens to the global economy if that future fails to deliver?